October 10th, 2025. Bitcoin sits at an all-time high of $126,000. Social media is exploding. Twitter threads screaming, "October is here!" TikTok gurus saying, "This is it! We're going to $150,000!" Retail traders are piling in. FOMO is at maximum. Then, the black swan hits. Overnight, Bitcoin plunges to $102,000. Over $19 billion in long positions liquidated in a single cascade. 1.64 million traders wiped out in hours. So here's the question. What did retail traders miss? And more importantly, what did professionals see 3 days before the crash? The answer wasn't in the news. It wasn't in some secret indicator. It wasn't in a paid Discord group. It was printed on every single chart in plain sight. Two things: price structure and volume footprints. Most traders look at charts and see random noise. Candles go up, candles go down. Social media says one thing, the chart does another, and somehow the account just keeps bleeding. If that's familiar, you're not alone. Because here's what nobody explains clearly enough. Price is just the advertisement. Volume is the transaction. Price tells you where the market moved. Volume tells you how much money actually moved there. If you only watch price, it's like judging a restaurant by its sign outside and never checking if there are any customers inside. In this video, I'm going to show you how professional traders read the market on 3 layers. Layer 1, the market cycle. Where are we in the story? Layer 2, smart money tactics. What play are institutions running? Layer 3, volume confirmation. Is it real or is it manipulation? These aren't 3 separate strategies. They're 3 lenses looking at the same thing. By the end of this video, you won't see random candles anymore. You'll see the heartbeat of the market, where institutional money is flowing, where traps are being set, and where real opportunities appear. This is not financial advice. This is education in how to read the game before you play it. Let's begin.
Most traders learn one method and swear it's the only way. Some worship Wyckoff, the only true way to read accumulation. Others follow smart money concepts. Everything else is outdated. And ICT disciples say only liquidity matters. Then they argue online about which is right. Here's what they're all missing. They're describing the same market mechanics from different angles. Think of it like studying anatomy. One doctor looks at the skeleton, the structure, the frame. Another doctor looks at the muscles, the movement, the action. Another looks at blood flow, the fuel, the energy. They're all studying the same body. They're just describing different systems. The same is true in trading. Wyckoff taught you cycle phases, the skeleton, the structure. SMC taught you liquidity traps, the tactics, the muscle movement. Volume analysis taught you confirmation, the blood flow, the energy. They're all correct because they're describing 3 layers of the same underlying truth. Markets don't move randomly. They move in patterns. And those patterns repeat because human behavior repeats. So instead of choosing one method and rejecting the others, we're going to combine them. Layer 1, we read the cycle to know where we are in the story. Layer 2, we identify the institutional play to know what's being set up. Layer 3, we use volume to confirm if it's real or manipulation. 3 layers, 1 truth. Let's break it down. Let's start with Layer 1, the market cycle. Back in the 1930s, a man named Richard Wyckoff spent decades studying how the stock market moved, and he discovered something profound. Markets don't move randomly. They move in phases, and every single phase follows the same story. 4 phases. Let me show you. Phase 1, accumulation. The market is quiet, sideways, boring. Most retail traders ignore it because nothing's happening. But behind the scenes, institutions are loading up. They're buying quietly, absorbing supply, building their position.
It's like watching someone pack for a trip. No excitement yet, but preparation is happening. Phase 2, markup. Now the fireworks start. Price breaks out. Retail traders flood in. FOMO kicks in. Everyone's making money. The news cycles turn bullish. Bitcoin to $150,000. The euphoria builds. But here's what retail doesn't see. Institutions aren't buying here. They already bought during accumulation. Now they're selling into your euphoria. Phase 3, distribution. The market goes sideways again, but this time it's not quiet. It's volatile. Fake breakouts, bull traps, price whipsaws up and down. Retail sees another leg up coming. They hold. They add more. Meanwhile, institutions are unloading, silently, methodically. And then, phase 4, markdown, the crash. Price plunges, stop losses cascade, liquidations explode. Retail traders are trapped underwater, panicking. And institutions? They're done. They're out, watching from the sidelines. And then the cycle begins again. Accumulation, markup, distribution, markdown. 4 phases, over and over, in every asset, every time frame, every market. If you know where you are in the cycle, you already know what comes next. But there's a problem. The cycle tells you the structure. It doesn't tell you the tactics. That's where layer 2 comes in. Now let's talk about layer 2, smart money tactics. You know the cycle. You know we're in distribution. Great. But how do institutions actually sell billions of dollars without crashing the price immediately? They need liquidity, and they get it by setting traps. Here's what that means. Imagine you're a hedge fund holding 10,000 Bitcoin. If you just market sell it all at once, the price would collapse before you finish selling. You'd lose millions. So instead, you do this. Step 1. You push price up slightly, just enough to trigger stop losses above a key level, just enough to attract retail buyers thinking it's breaking out. Step 2. Retail sees the breakout. They buy. Their stop losses sit just below the entry point. Step 3. You sell into their buy orders. They provide the liquidity you need. Step 4. Once you've sold enough, you let price fall. Their stop losses trigger, liquidations cascade, and you buy back lower if you want to reload. This is called a liquidity grab, or a bull trap, or a stop hunt. It's not conspiracy. It's not manipulation in the illegal sense. It's just how big money moves. Think of it like fishing. You don't just throw a net randomly into the ocean. You find where the fish are. You use bait. You wait, and then you pull. Institutions find where retail stop losses are clustered. They bait price into those zones, and they capitalize. So how do you spot this? Look for sharp wicks above or below key levels. Look for fake breakouts that immediately reverse. Look for price sweeping liquidity zones, then snapping back. But here's the thing. You can see the trap being set, but how do you know if it's working? That's where layer 3 comes in, volume. Layer 3, volume confirmation. This is the truth serum. This is what separates real moves from fake moves. Volume tells you how much money actually changed hands at each price level. If price moves up, but volume is low, it's weak. It's not backed by conviction. It's probably a trap. If price moves up and volume is high, money is flooding in. Institutions are involved. The move has weight behind it. Think of it like this. Price is the scoreboard. Volume is the crowd in the stadium. If the scoreboard says your team is winning, but the stadium is empty, something's wrong. Maybe it's a practice game. Maybe nobody cares. The scoreboard alone doesn't tell the full story. The same is true in markets. Price breaks above resistance. Looks bullish, right? But if volume is dropping as price rises, that's a red flag. It means fewer and fewer buyers are participating. The move is running out of steam.
But if price breaks above resistance and volume spikes, that's different. That's real demand. That's institutions moving. That's a move you can trust. Let's go back to October 10th, 2025. Bitcoin was at $126,000. Social media was euphoric. Everyone thought it was breaking higher. But if you looked at the volume, you'd see something chilling. For the previous 3 days, price kept making higher highs, but volume kept dropping. Each new high had less participation, less money moving, less conviction. That's a classic sign of distribution. Institutions were selling, retail was buying, but the buying was getting weaker. And then, on day 4, the crash. If you'd been reading volume, you'd have seen it coming. Not with certainty, but with probability, with awareness. And that's the edge. Not prediction, preparation. Okay, let's put all 3 layers together and walk through October 10th step by step. Layer 1, the cycle. Bitcoin had been in markup since July. Months of uptrend, euphoria building, news turning bullish, everyone talking about 150K by Christmas. But if you look at the Wyckoff cycle, we were clearly entering distribution territory. The trend was mature. Exhaustion was setting in. Layer 2, smart money tactics. On October 3rd, 5th, and 7th, price made 3 attempts to push price up. Each attempt swept liquidity above the previous high. Each attempt triggered retail buy orders. Each attempt gave institutions the liquidity they needed to unload. And notice, each breakout attempt failed within hours. Price would spike, then fall back. That's not bullish strength, that's distribution in action. Layer 3, volume. This is where it gets damning. October 3rd, Bitcoin hit $123,000. Volume, 24 billion. October 5th, Bitcoin hit $125,000. Volume, 19 billion. October 7th, Bitcoin hit $126,000. Volume, 14 billion. Price going up, volume going down. That's divergence. That's distribution. That's institutions selling while retail is buying. And then the price dropped, establishing a series of lower lows and lower highs. On October 10th, the trap was sprung. Price spiked to $122,000 one more time. Then it collapsed. $102,000 in 6 hours. $19 billion in liquidations. Retail traders who bought the breakout were wiped out. Institutions who'd been selling for 3 days were sitting in cash, watching. This wasn't luck. This wasn't insider information. This was reading the layers. Layer 1 told you, we're late in the cycle. Be cautious. Layer 2 told you, liquidity grabs are happening. Traps are being set. Layer 3 told you, volume is declining. The move isn't real. If you'd been watching all 3, you wouldn't have been caught. You might not have shorted it, but you wouldn't have longed it either. You'd have been on the sidelines, prepared. And that's the skill we're building here. Now let's talk about why traders still lose even when they know these concepts. Because knowing isn't enough. Execution is everything. Mistake 1, ignoring the bigger time frame. You see a bullish setup on the 15-minute chart. Volume's good, structure looks clean, you enter. But if you'd zoomed out to the 4-hour chart, you'd see you're buying into a distribution zone. You're trading against the bigger cycle. Always trade with the bigger time frame, not against it. Mistake 2, letting FOMO override the data. You see Bitcoin pumping, social media is going crazy, your group chat is celebrating. You know the volume is declining, you know it's late cycle, but you don't want to miss out, so you enter anyway. And then you're holding a losing position hoping it comes back. The market doesn't care about your emotions, it rewards discipline. Mistake 3, overcomplicating the process. You start adding 15 indicators. You're watching 8 time frames. You're cross-referencing divergences, oscillators, moving averages. And then you're paralyzed.
Too much data, no clarity, no action. The best traders keep it simple. Cycle, liquidity, volume. That's it. You don't need a PhD in technical analysis. You need clarity on what matters. So let's talk about how to actually apply this. Here's your step-by-step framework for reading any chart. Step 1. Identify the cycle phase. Is price in a long sideways range? That's accumulation or distribution. Is price trending strongly in one direction? That's markup or markdown. Is the trend mature or fresh? If it's been running for months, be cautious. Start with the daily or 4-hour chart. Get the big picture first. Step 2. Look for liquidity zones. Where are the obvious support and resistance levels? Where are stop losses likely clustered? Institutions love these zones. They'll push price into them to grab liquidity. Expect fake breakouts. Expect wicks. Expect traps. Ask yourself, is this move hunting stops or is it genuine momentum? Step 3. Check the volume. If price is making new highs but volume is declining, be skeptical. If price breaks a key level and volume spikes, pay attention. If volume is flat during a big move, it's probably not backed by institutions. Volume is your confirmation layer. It's what tells you if the move is real. Step 4. Wait for alignment. Don't trade unless all 3 layers agree. Cycle says, we're in early markup, bullish context. Liquidity says, we just swept a low and bounced, trap cleared. Volume says, spike on the bounce, real demand. That's when you enter. When all 3 layers point the same direction. If they don't align, you wait. Patience is the edge. This framework won't make you rich overnight, but it'll keep you out of bad trades. And in trading, not losing is winning. Let me be clear about something. This approach doesn't predict the future. Nothing does. Markets are probabilistic, not deterministic. That means you can read the cycle perfectly. You can spot the liquidity trap. You can see volume divergence, and the trade can still lose. But here's the difference. When retail traders lose, they don't know why. They feel helpless. They blame manipulation or bad luck. When professional traders lose, they know why. They had a reason to enter. The probabilities were in their favor. But probabilities aren't certainties. They accept the loss and move on. Trading is about process, not outcomes. If you follow the process, read the cycle, spot the tactics, confirm with volume, you'll be right more often than you're wrong. You won't win every trade. No one does. But you'll have an edge. And over time, an edge compounds. Don't chase perfection. Chase consistency. Trust the process, refine it, learn from your mistakes, and slowly the market will start making sense. So where do you go from here? So here's where we are. You've learned the 3 layers: cycle, liquidity, volume. You've seen how they work together. You've walked through a real-world case study. You've learned the common mistakes and how to avoid them. You now have a framework, not a crystal ball, a framework. And that's all you need, because trading isn't about knowing the future. It's about reading probabilities and acting with discipline. And if you found this valuable, consider subscribing. I create educational content like this every week. No hype, no secret signals, just deep breakdowns of how the market actually works. The goal isn't to become a fortune teller. The goal is to become a reader, to see the heartbeat of the market, where money is flowing, where traps are being set, where real opportunities appear. You don't need luck. You need clarity. Thanks for watching. See you in the next one.